Hindenburg Research has just released a damning report about Icahn Enterprises and accused the company of having a Ponzi-like economic structure. They also have taken a short position on Icahn Enterprises, which means that Hindenburg is betting against the stock price of Icahn Enterprises, hoping that it will decrease. For those who are not aware of Hindenburg Research, they are a well-known short-selling firm that has gained notoriety for its controversial reports on companies like Nikola, Adani Group, Block, aka Cash App, and Clover Health. Short selling is a risky strategy where an investor borrows company shares, sells them, and hopes to repurchase them at a lower price to profit from the difference. However, the investor can lose money if the stock price goes up instead of down. Icahn Enterprises, IEP, is an $18 billion market cap company run by corporate raider and activist investor Carl Icahn, who along with his son Brett owns approximately 85% of the company. The company is a diversified conglomerate with subsidiaries in various industries such as energy, automotive, and real estate. So what does the Hindenburg's report claims? We have gone through the detailed report and come up with an easy-to-understand summary for you. So let's dive right in. According to the Hindenburg Research, IEP units are inflated by 75% plus due to three key reasons. Number 1. IEP trades at a 218% premium to its last reported net asset value, NAV, vastly higher than all comparables. Number 2. There is clear evidence of inflated valuation marks for IEP's less liquid and private assets. Number 3. The company has suffered additional performance losses year to date following its last disclosure. Most closed-end holding companies trade around or at a discount to their NAVs. For comparison, vehicles run by other star managers, like Dan Loeb's Third Point and Bill Ackman's Pershing Square, trade at discounts of 14% and 35% to NAV, respectively. Hindenburg further compared IEP to all 526 US-based closed-end funds in Bloomberg's database. Icahn Enterprises' premium to NAV was higher than all of them and more than double the next highest they found. A reason for IEP's extreme premium to NAV, based on a review of retail investor-oriented media, is that average investors are attracted to IEP's large dividend yield and the prospect of investing alongside Wall Street legend Carl Icahn. Institutional investors have virtually no ownership in IEP. Icahn Enterprises' current dividend yield is about 15.8%, making it the highest dividend yield of any US large-cap company by far, with the next closest at about 9.9%. As a result of the company's elevated unit price, its annual dividend rate equates to an absurd 50.5% of the last reported indicative net asset value. The company's outlier dividend is made possible, for now, because Carl Icahn owns roughly 85% of IEP and has been largely taking dividends in units, instead of cash, reducing the overall cash outlay required to meet the dividend payment for remaining unit holders. The dividend is entirely unsupported by IEP's cash flow and investment performance, which has been negative for years. IEP's investment portfolio has lost about 53% since 2014. The company's free cash flow figures show IEP has cumulatively burned about $4.9 billion over the same period. Despite its negative financial performance, IEP has raised its dividend 3 times since 2014. IEP's most recent dividend increase came in 2019 when it raised quarterly distributions from $1.75 to $2 per unit. IEP's free cash flow was negative $1.7 billion in the same year. Given that the investment and operating performance of IEP has burned billions in capital, the company has been forced to support its dividend using regular open market sales of IEP units through at-the-market (ATM) offerings, totaling $1.7 billion since 2019. In short, Hindenburg claims that Icahn has been using money taken in from new investors to pay out dividends to old investors. Such Ponzi-like economic structures are sustainable only to the extent that new money is willing to risk being the last one holding the bag. Supporting this structure is Jefferies, the only large investment bank with research coverage on IEP. It has continuously placed a buy rating on IEP units. Calling it one of the worst cases of sell-side research malpractice, Hindenburg says that Jefferies' research assumes in all cases, even in its bear case, that IEP's dividend will be safe into perpetuity, despite providing no support for that assumption. Since 2019, one bank has run all of IEP's $1.7 billion in ATM offerings, Jefferies. In essence, Jefferies is luring in retail investors through its research arm under the guise of IEP's safe dividend, while also selling billions in IEP units through its investment banking arm to support the very same dividend. Adding to evidence of IEP's unsustainability, Hindenburg estimates that IEP's last reported indicative year-end NAV of $5.6 billion is inflated by at least 22%, due to a combination of overly aggressive marks on IEP's less liquid and private investments, and continued year-to-date underperformance. In one example, IEP owns 90% of a publicly traded meat packaging business that it valued at $243 million at year-end. The company had a market value of only $89 million at the time. In other words, IEP marked the value of its public company equity holdings 204% above the prevailing public market price. The mark is even more irregular given that IEP bought over 1 million shares of the company in December before immediately writing up the value of those shares by about 194% in the same month. In another instance, IEP marked its automotive parts division at $381 million in December 2022. Its key subsidiary declared bankruptcy a month later. IEP reported $455 million in real estate holdings in its most recent quarter. The reported values in this segment have been remarkably stable for years despite declining net income and despite including the Trump Plaza in Atlantic City, which was razed to the ground in 2021. A country club that became nearly insolvent in 2020 before ownership reverted to its members in 2021. And a lack of transparency on other assets and valuations. The irregular valuation marks fit a pattern. In January 2020, UBS dropped coverage of IEP citing a lack of transparency following its research showing marks that were divergent from the public market values, among other issues. Beyond aggressive marks, Icahn's liquid portfolio has continued to generate losses. Hindenburg's analysis of Icahn's latest December 2022 13F filing indicates that IEP's long holdings have lost about $471 million in value year-to-date, despite the S&P gaining about 9.2% in the same timeframe. IEP disclosed that its investment fund had a 47% notional short bet in its December 2022 filings. Given the positive market performance, Hindenburg estimates that this short bet has contributed at least a further $272 million in year-to-date losses. Tightening matters further, IEP is highly levered, with $5.3 billion in holdco debt and maturities of $1.1 billion, $1.36 billion, and $1.35 billion due in 2024, 2025, and 2026, respectively. IEP's debt covenants limit the company's financial flexibility. IEP is not permitted to incur additional indebtedness and is only allowed to refinance old debt. With interest rates having increased, IEP will need to pay significantly higher interest expenses on future refinancings. Carl Icahn's ownership in IEP comprises about 85% of his overall net worth, according to Forbes, giving him limited room to maneuver with his own outside capital. Hindenburg claims that Icahn has little ability or reason to bail out IEP with a capital injection, particularly at such elevated unit prices. Further underscoring Icahn's limited financial flexibility, he has pledged 181.4 million units, about 60% of his IEP holdings, for personal margin loans. Margin loans are a risky form of debt often reliant on high share or unit prices. Icahn has not disclosed basic metrics around his margin loans like the loan-to-value, LTV, maintenance thresholds, principal amount, or interest rates. Hindenburg believes that unit holders deserve this information in order to understand the risk of margin calls should IEP unit prices revert toward NAV, a reality they call as inevitable. Given limited financial flexibility and worsening liquidity, Hindenburg expects Icahn Enterprises will eventually cut or eliminate its dividend entirely unless a miracle turnaround in investment performance happens. Overall, Hindenburg claims that Icahn, a legend of Wall Street, has made the classic mistake of taking on too much leverage in the face of sustained losses, a combination that rarely ends well. These are pretty damning revelations from Hindenburg Research. We leave it to you how you perceive this information, but would like to mention that these are claims made by Hindenburg Research, who have a conflict of interest in the matter, having taken a short position on IEP stock. Please take qualified financial advice before acting on any of this information. Thank you. Please like, share and subscribe to get a better sense of money, business and the economy in general.